Welcome back. Did you know you can make really good passive income selling options? And one of the greatest ways to actually sell options is using what's called the option wheel strategy. You can really do well with it. Today, I want to share with you two bargain stocks that I'm running the wheel on. I'm actually going to share with you some trades, and I'm going to talk about how I do the wheel different from other people. So stick around. I think you're really going to enjoy what I have for you. Okay, I typically like to do a quick market update at the beginning of my videos. I don't really have much to add. This is actually the time that I'm recording this is actually Tuesday, November 14th, and the release is going to be the 16th of November. As of today, the market's way up. I believe the numbers that came out this morning related to inflation showed that maybe inflation was a little bit more under control than what the Fed was expecting. So I believe still no increase coming later this year. I believe personally that we probably will get some decreases or cuts next year, maybe second quarter. I think the consensus is between 2 and 4 cuts. I still think that's going to happen, especially during a presidential year. The only other concern I have for this week is, will the government have a shutdown? But even that looks pretty good. It looks like it won't be any kind of a shutdown. So that being said, I still think we're probably going to be moving sideways. The market, again, is up today. And I do think we're going to be trending up more so than down. But I still kind of see some good days and some bad days. I'm not necessarily thinking we're out of the woods yet. But I do feel like we probably will get a pretty good rally towards the very end of the year, probably what's called a Christmas rally. So at least that's my 2 cents. And as always, it's probably only worth 2 cents. So let's jump into the main piece of the video. Again, I'm going to share two bargain stocks. These are CVS and Citigroup. I'm going to share my trades at the very end and talk about how I've been doing the wheel on them for both of them for quite a while. CVS, I think I've only done a couple trades but for Citi, I believe I've done quite a few. I've been trading Citigroup going all the way back to the beginning of last year, but I'll share that at the very end of the video. But I did want to mention that there are some great bargains out there. These are just two of the bargains. You don't necessarily have to take a huge risk with some of these high flyers. These are good quality stocks. Both of the two that I'm talking about today pay good dividends or growing dividends, have low debt, have potential good gains next year, year over year. So they fit the nice criteria I typically like to look at. Now, when you're doing what's called the wheel, and that's my main focus I wanted to talk about today, how I do the wheel strategy. But to start off, to do the wheel strategy, you need to be able to afford 100 shares of whatever stock you're looking at. Both of these stocks, I believe CVS is in the mid 50s, and I believe Citigroup is right around the low 40s. So you need for Citigroup, you would need around $4,000 or enough to buy 100 shares. And for CVS, like 5,500 to 6,000. And again, that's for one contract. And contracts for options are always in $100 increment, not $100, 100 share increments. So that's kind of the basic to get started. You need enough to cover that. I don't do naked trades. I don't like to use margin. I typically like to have enough cash to buy these companies, and typically I want to buy these companies. Now, if things majorly change while I'm running the wheel, that I might decide against keeping them, but typically I really do want to keep them. So next, what you do is once you have enough cash, then you can sell a cash secured put on the particular stock you want to own. So for me, I will take a little bit more risk with running the wheel versus just a vertical put credit spread or a cash secured put that, I might be running at other times. With the wheel, I feel like it's okay to take a little more risk. And I think that's really true if the stocks are selling at a bargain, meaning they're pretty close to their 52-week low. And, you're picking them up at a good value. I do think it's okay to go with a higher delta, maybe a 35 or 40 delta even, versus the 15 delta that I typically like to do. And then I'm trying to stick to a shorter time frame. So I'm trying to do it for expiration within 90 days, so no DTEs beyond 90 days. And that's so that I can turn the wheel more often and make a little bit more money. And my hope again is for these to get assigned. So what happens is right around expiration, a few things might happen. You might be able to close it if you no longer want to own the stock. You could also roll it, or you could let it expire and set up another cash secured put, or you can allow assignment if it's actually in the money. And again, when you're doing the wheel, that's kind of the goal is to let it get assigned so that you own those shares. So at that point, if you do get assigned and suddenly you find that you own 100 shares, you can then sell what's called a covered call. So since you already own the 100 shares, people will pay you money for the opportunity to buy those shares from you. So again, you can, sell a covered call, take a little bit more risk than what I typically take with covered calls. Now, my strategy is a little bit different. A lot of times I want to keep these stocks forever. So once they're assigned to me, I might go with a little bit of a lower delta for the covered call, more like a 20 delta, mainly because I want to keep these stocks. Now, that's typically been the case, especially in my regular individual accounts, my non-tax-free accounts. But in my retirement accounts, I'm looking at it differently since I'm not being hit tax-wise. I can keep, buying and selling and buying and selling, and there's really no impact. So for my retirement accounts, again, I'm taking more risks. So if it's an IRA, I will look at doing a much higher delta, maybe a 25, 35, 40 delta. And a lot of times very close to the delta, not the delta, the strike that I was using when I sold the cash secured put. So if the strike was a 40, well, I might look at a 42.50 covered call strike, which would, just by the nature of it, have a higher delta, mainly because I can, if I can pick up $2 or $3, which translates into $200 or $300 on the cash secured put, and the same thing on the covered call, then I can make a lot of income very quickly and maybe only have the stock for maybe 2 to 3 months, earning a really good return. So at least that's what my goal is. So in these retirement accounts, especially, with it very close to the money, again, the chance of it being assigned away from me is fairly high. And the situation is again very similar. You could potentially close it if something has changed and maybe you don't want to give up that stock because you like it. You could roll it, that way you can avoid letting it be assigned away from you. And when I first started with covered calls, I didn't even know you could roll. And I started 12 years ago and I did very well with covered calls without ever rolling. I just picked a price. I told myself, well, I'm willing to part with this stock at this price. And that worked out very well. Now, in the last 2 or 3 years since I've been on this journey, I've chosen the strike price more on a delta basis, on a probability that it might get assigned away from me. And that's worked even better. I've had very few covered calls get assigned away from me. I've had a lot more cash secured puts assigned away from me. But going forward, like I said before, I'm probably going to take more risk in my retirement accounts and let those, the purchase and the sale occur more often again, so I can spin that wheel even faster. So in those instances, I would let assignment occur. So someone would pay me, that premium as well as for the value of the stock. So again, if it's a $40 stock, I would get, the $4,000 for the stock itself and whatever premium that I picked up. So again, I would have premium going into my account. And I know I might be confusing some people, especially if you're new to selling options, but I'll show real examples at the end of this video, so stick with me. But long story short, if it's not unusual if it's a $40 stock that you could potentially in a short period of time make $400 on that $40 stock, just running the wheel. Maybe pick up $2 when you sell the put initially, and then it gets assigned, and maybe make another $2 when you sell the call, and do that in a fairly short time frame, maybe 3 months or 2 months. or maybe a little longer. It might take 4 to 6 months, but it can work out really well and you can make a lot doing it. And then again, you just keep repeating the process and you can earn quite a bit. And what I've found with doing bargain stocks like CVS and Citigroup, it can work out really well. And if you do end up owning them, both pay really good dividends. So let's stop at that point. I don't want to go into tons of detail here. It's easier to actually show examples. So let's jump into the next part of the video, and I'll go into detail about my trades, my CVS and Citigroup trades. So stay around. Let's jump into the next part. Let's go ahead and jump into Citigroup. I do want to mention, as always, please hit that like button, subscribe. If you're curious about my memberships, take a look below. I had a lot of interest. I'm probably going to limit how many people can join, especially the more expensive version of my membership. I'm also looking at changing them. Maybe on January 1st, I'll have slightly different tiers. I currently only have 2 tiers, and I'll probably add a third. So if you're curious, take a look below. I have details in the description. So that being said, let's jump in and talk about Citigroup. Now, Citigroup, I feel, is a great bargain. You can see it's actually up big time today, $1.63. It's currently at $44.33. But when I was first messing with Citigroup and I started doing the wheel, it was up into the mid 60s. So it's really come down, and you would think, well, they must have done some terrible things or, made some big mistakes, but not really. If you look, Morningstar has a really good review for them. They've got buy ratings by different analysts. Their earnings have typically been good. Hopefully the page here will refresh. There we go. But you can see they've beaten earnings all year. Their latest earnings was $1.63 when it was projected to be $1.21. They have a really low PE. Dividends, they pay almost 5% in dividends. It was 5% before the big increase today. They haven't increased them much, but they have plenty of cash to cover them. Here you can see the dividend coverage ratio is really high, which means the payout ratio is really low. So they have plenty of cash to pay the dividends. If you had owned them back in 2013, you'd only get 4 cents in dividends. Now you get probably close to $2.50. So long term, they've increased dividends quite a bit. They slowed down more recently. But overall, a really good company. Let's look at their debt. Again, they're a credit card company, so their debt typically you would think would be higher, but it's actually not too bad. They, 501, it's high, but again, like I said, they're a credit card company, but not way out of range compared to their total equity and shareholder value. So that's okay. That may be a little bit higher, but again, it's a little less worrisome with the fact that they are, they specialize in debt, so that's not unusual. Now, if we look year over year, their numbers look good. Looks like year over year they're going to have an increase. They are going to have a rough first quarter 2024. I don't know if that's because of people not being able to pay their credit cards. They might have to write some things off. I don't know details. But then second quarter is supposed to be pretty good. And third quarter, not terrible, but it's going to be down some. So their year over year is down a little bit, but not to the point where it warrants this kind of a decrease in value. But you can see they are having a little bit of a recovery. So with doing the wheel with them, definitely you can take more risk with the fact that, it's pretty close to its 52-week low of $38. So you can write a put pretty close to that value and still do fairly well. I've been trading this a long time. At first, I really wasn't doing the wheel. I was just running cash secured puts. Let me show you what that looks like. So I started back all the way in 2021, back in February of 2021. And just at first, I was just doing single cash secured puts. And I did more and more and continued to do them until I got assigned in November of 22, and I picked up 200 shares at 52.50, which at that point it had dropped a lot. The required capital was 10,500, and at that point I started selling covered calls, and I did quite well with covered calls. I typically have always been able to double the dividend to, with a 4.5 to 5% dividend, I've been able to double that and earn between 8 and 10% on average. And I've even written one recently on 11/13, which was yesterday. I did another Citigroup dividend and rolled it, not dividend, and rolled it out and picked up some good, nearly $180, 185 yesterday, actually rolling it out. And at around the same time, well, actually this was 825. I also picked up dividends. So here you can see I picked up 106 in dividends, which here's the previous time, 102. So again, showing that they've increased their dividends some. So it's turned out to be a really good company. Now, if I had not been selling options, I probably would not have a profit. So that's based on the value of Citigroup today. So right now I've got a small profit with them, but with the fact that it's fallen so much, we'll go back to what I was showing here. If you look back, I started trading when it was up here, and then it's come down. But even at this rate, I'm still profitable at this point. Now, if it comes back up into the mid or high 40s, then I'll be very profitable with it. If I hadn't been selling cash secured puts and covered calls, I would be down a lot more compared to where I am now. If you go back 3 years, you can see how much it's come down. So in my mind, it's a good stock, good company, beaten down. If you're looking at doing the wheel with it currently, you can do pretty well with it. You can pick pretty low strikes and kind of pick up some really good premium. It probably the low 40 range, like 42 or something along those lines. So let's next jump into CVS, which I'm actually trading in a different account. I'm trading it in my Fidelity account. So let's jump into that next. And now I've opened up my Schwab account with CVS, and here you can see it's currently 68.54, and it's been hammered over the last 3 years. At one point it was trading significantly higher, over 100, and it's just come down and down and down. And I have a CVS right near me, and I'm in there all the time. Their prices are really high, but the convenience of picking up something quickly, I seem to go in there a lot to pick up Gatorade, and if I need something quickly, it's so close, it makes a lot of sense. And so I'm okay with paying the high prices, especially on occasion where I just need to get something quickly. But you can see they've got an A rating from Schwab, Morningstar 5, Outperform, 3 stars from CFRA, Argus has got a buy. So some pretty good reviews. Now, their dividend is nearly 4%. Okay, it's taking a minute to run. Okay, here we go. They were flat for a while, but now they're increasing dividends again. And so you can see nearly 4%. They have, again, plenty of cash to cover the dividend. The payout ratio is only 35%, the coverage ratio, which those correlate. This is one of the, it's a nice level. It's high enough to know that they can continue to pay these dividends, which is really important. So they haven't been growing them as much recently as they have long term, but they definitely have been increasing them. If you had started with them back again in 2013, you would have picked up 90 cents on a share. Now it's over 242. which I think it's probably going to be a little higher than that. What's their 61 cents? So yeah, 240, 242. So that's a significant jump from 90 cents to 242. Now let's look at their earnings. They've beaten earnings all year, not by huge amounts, but very consistent, very low PE. Price to earnings growth is nice too. Let's jump down and look at their debt. Okay, now their debt, they've been decreasing it. This year it's 52 billion, the previous year 56, 64, 68, 73. So again, reducing debt, another key point I like with any of these companies I'm looking at. And then let's look at their year over year. So their projections aren't the best. They are going to be up slightly, but it's pretty consistent, barely down, maybe less than 1%, 0.2 of a percent. Down a little bit first quarter 2024, up a bit, so pretty consistent. Their earnings are going to stay pretty near what they are today. So overall a good company. So I actually did a trade yesterday on them, and let me show you what that looked like. So here you can see I actually picked this 65 cash secured put, which had a slightly higher delta. Now I'm showing you what the page looks like. I took a snapshot of Fidelity, and I do like how they do their change. So I sold the 65. I brought in about 174 a share. I'll show you the actual trade. So with the idea, if I own it at 65, I could come over here and do a covered call at 67.50 and bring in between 305 and 315, and potentially do that fairly quickly. So they typically have lots of activity, lots of volume and open interest. So typically a very good company to trade with. Now let's come over here to the actual trade. So here's what it looked like. So 287.40. And I felt like the 28 cents for purchasing the call was well worth it. So I actually did a vertical put credit spread instead of cash secured put. And I find that I'll do that a lot potentially, especially if I can buy the put at a good price. So with this trade, I picked up $287.40. Here's the actual status of when it occurred. And I actually improved a little bit with the purchase. I think I got 26 cents, which I believe this was 28 cents. Yeah, so I did a little bit better. I got more like the midpoint. And then let's see, this, I got 173, which was on the low end versus the 178. So 287.40, I could have picked up another $52. So it could have been more like 340 or right around 340. If we're doing a cash secured put. So spending a little or picking up a little less premium to me was well worth it. And so that's why I did it as a vertical put credit spread. But again, the goal is the same. I'm okay with it getting assigned to me. And then if it does get assigned to me, I'll probably have some value in the put that I purchased, and I can also sell that. So, and again, with the fact that it's the wheel and I do want to spin it, I am taking a bit more risk. So I typically would not have, I wouldn't have picked this one here with the 34 delta. I would have picked the 15 delta, which, would have been more like $60. But again, I feel like with this pricing, when we come back up and where the price is now, it's really beaten down. It's really close to its 52-week low. Its 52-week low is 64. So literally the 65 is right there. And with the cash that I picked up, I'm actually lower than the 52-week low. I think it's going to recover if you look long term. I wouldn't be surprised if it got back into the low to mid 70s. So I could have a nice return with it. But again, the fact that I can double the dividends and potentially make 8% just with dividends, not including any appreciation. I feel like it's a really good opportunity. So those are the two stocks I wanted to share this time, and I wanted to go into a little bit more detail about running the wheel. So hopefully before too long, I'll own another 200, or not another, but I'll own 200 shares of CVS, and then I'll sell covered calls on it just like I am with Citigroup. So as always, if you have any comments, concerns, questions, please leave a message or a comment, and I typically will respond to them. It might not be within the first 24 or 48 hours, but typically I do try to respond to any comments that people might have. And as always, thank you for joining me, and I look forward to seeing you next time.